Hey everyone.
Gonna do your Irish accent? Or?
I don't have an Irish accent.
Oh, disappointing.
How about you?
Definitely not. It's good to be with you all today. How's everyone finding SaaStock? Woo, woo, cool. We're massive fans of SaaStock. I know Kyle is too. We've been here probably 5 years in a row. You've come here every year as well. So it's good to be in town. We're having some great conversations, and today we're going to have another of those conversations because I've got one of the smartest people in SaaS metrics and PLG sitting next to me, so most of my job now is to shut up and let him talk. I'm going to spend maybe 20 minutes diving into the latest SaaS Benchmarks report. Do you want to give people maybe just a quick overview of what's been happening in the market? Because I think sometimes we're so focused on where we are right now. Perhaps you can just walk backwards a bit, tell people about, firstly, who you are, and then a little bit about what's been happening over the last 12, 18 months, and then we'll dive into some of this data.
Yeah, sounds great. So I'm at OpenView. We're a VC firm investing exclusively in expansion stage software companies, typically Series A, Series B companies. And I work with our portfolio companies on growth and go-to-market strategy. About 7 years ago now, I launched the first SaaS benchmark survey that we did at OpenView. The thinking is, we kept getting questions from our portfolio companies of, what's an expected or healthy growth rate for my stage? How much should I burn in order to achieve that growth? What's a healthy CAC payback period or net dollar retention, right? They might see what the public SaaS companies look like, right? But these are, the 0.1% of SaaS outcomes. What's more of that, median or top quartile for a company that's a couple million ARR? So we've now been tracking that data for 7 years and have had around 4,000 companies participate in that data set. And Andrew and I were just reflecting on where we were at this time last year and what's happened this year, and it's changed a bit. Last year, the theme of the report was whiplash, and it's because we really went on this growth roller coaster, right, where valuations went through the roof, and then valuations crashed seemingly overnight. Valuations for the highest growth software companies were down about 80% at this time last year, and the number of new unicorns came crashing down. And then this year, it's actually fascinating. Valuations have stabilized relative to growth rates, but now growth is much harder to come by. And so we'll talk more about some of the findings this year, but it's just fascinating to reflect on the changes in this landscape.
So let's just dive straight in, and let's talk firstly about growth rates in public SaaS, which we all can see out open and publicly. Let's talk about this first, then let's dive into private, which is most people in the room.
So publicly traded software companies report their key metrics, like how fast they grew their revenue, every single quarter. And so we now have pretty interesting data on publicly traded SaaS companies and how fast they grew through Q2 of last year and how fast through Q2 of this year. And you can see with those red arrows, we were flagging here all SaaS companies, all PLG companies, and then a selected group of the most well-known, most kind of highly valued SaaS companies. There are no green bars where growth increased, right? It's only red and more red, right? You could see Snowflake's growth rate came down from 98% to 60%. So no one was spared. Even the best of the best companies with the smartest, most highly paid operators are finding it challenging to sell in the current environment. And one thing that I will point out is that product-led growth companies were impacted even more than the rest of the SaaS industry, seeing growth rates come down from 45% to 29%. So if you're feeling like it's harder to sell in this environment, you're definitely not alone.
I find that really interesting, though, because although they've reduced more in growth rate, they're still growing faster than the overall base of all SaaS companies. So they're proving more resilient, even though the unit economics are meaning that people are having to focus on efficient growth.
Yeah, absolutely. And I think that's still worth pointing out. It's not like this growth model is dead or dying, or people saw Airtable investing in enterprise and said PLG's dead. I think you can look at Loom, Notion, many others, and say it's still a pretty healthy growth model or part of a growth model for a business. But I'll readily admit, when we look at PLG companies from a year or 2 years ago, many of them looked a bit like Noah's Ark. They had two of everything. They had many more people in R&D than their peers as they invested in that product-led motion, and they built massive sales teams that often were alongside more traditional sales and marketing organizations. And so they were spending more on both sales and marketing and R&D. And yes, that resulted in faster growth. But today, as we focus on efficiency, PLG companies have gotten a lot more lean and really leaned on this idea of product-led growth is driving much more efficiency in the go-to-market motion by taking things that would have historically been done by people and bringing product-based solutions, right? Where you don't necessarily need to cold call someone, do a series of demos. Someone can find your product, sign up for free, start using the product, and then talk to someone on your team.
Cool. So now let's just go into the private markets. So one of the privileges we have at Paddle is we serve about 5,000, mostly PLG businesses, helping them scale globally, payments, tax compliance, subscription management, all of that stuff. And so we see lots of data. We also have access to, through an acquisition of ProfitWell, access to a metrics product that sees 36 billion of ARR. And so we see, 30-odd thousand companies and their financial metrics. And the private markets, when we mix this real-time data set into the survey data that Kyle spoke about, we also see this declining growth rate. Now, I would point out that people are still growing. And in previous market corrections, we've actually seen a bit of shrinkage in SaaS. So the good news is people are still growing. 2 double clicks on this data. When we look at actually net new ARR, what we're finding is companies are finding it easier to grow from their existing install base or customer base. So they're generating more MRR, ARR from existing customers than net new from new customers. And when we look at downgrade and cancellations, there's a very clear difference between people choosing to optimize for logo churn or revenue churn. And all of us in this room have got to decide, based on our economics and our business model, do we want to hold on to customers even if they downgrade or pause their plans or stop paying us so that we have the chance of working with them in an upswing when the winds are behind us again? Or do we want to protect revenue at all costs and lose as many customers as we need to protect full basket size from the remaining customers? So that's an extra nuance in this data. You've got to think about both sides of this, new MRR and the MRR you're losing, and decide what you're optimizing for. So we're going to dive into a few of the outliers that Kyle and his team have pulled out some very interesting slides, 0 and 3. We're going to be digging into the outliers. We're going to take 3 outliers. So Kyle, firstly, can you just quickly explain what an outlier is, and then dive into the first one, which of course is something to do with AI?
Yeah, we have to talk about AI, right? So when we looked at the data, growth has been a lot harder to come by, but there were 1/4 of companies in the data set that were insulated from this challenging economic environment. These are companies that grew as fast or even faster than they've grown historically. And it's no surprise that AI would be on this list. When you look at companies like OpenAI, their revenue run rate was reportedly $30 million last year. It's on track to be well over $1 billion this year. Right? There's been some pretty sizable demand for AI products. So when we unpacked who were the outliers, the first factor that jumped off the page were AI native companies. So these are companies where the core of their innovation is around AI. And AI natives were 230% more likely to be outlier companies. But the thing to note is these were only 10% of all outliers and only about 4% of the companies in the data set. So this is still a relatively small number of companies relative to the broader SaaS landscape. The next factor that was actually much more significant were vertical software companies. So vertical software companies sell to really specific industry verticals or customer targets, often customers who are underserved by traditional software. So you might think about, for instance, companies like Toast in the restaurant technology space or ServiceTitan, right? And vertical SaaS companies were 120% more likely to be outliers, and they represent 49% of outliers. And so one takeaway, if you're here and thinking about, hey, do I go after a narrow ICP or a very wide ICP? The data shows in this current buying environment, the narrower and more specific customer target you have, the better chance you have of standing out and really winning in that market. The third factor I just want to point out on this slide is there are a number of companies that aren't AI natives, but they have AI features. And everyone raced to implement AI, add AI to their roadmap over the last year. Some of those companies added AI and monetized them. And the companies that added AI and monetized them were 50% more likely to be outliers, and these were 17% of outliers. You might think about companies like Notion, which added AI and charges $8 per seat. So they're getting almost twice the price from a customer that buys AI. That's a really great tailwind to support future growth, right, through that cross-sell motion. Or companies like Intercom added AI, and they charge for every successful resolution. And so what's interesting there is it makes it super easy for their customers to try AI, and they're only paying if it works. And then this leads Intercom to be incentivized to add more and more value by resolving more cases through AI. So key things to think about, though, are if you just added AI to your roadmap and didn't monetize it, you actually have a negative correlation with being an outlier. So we're not saying go rush and add AI to your roadmap. AI washing is a real thing, and it's not a great way to grow your business.
And I mean, we've both seen lots of people sprinkling AI pixie dust over their pitch decks and over their product roadmaps. And it was really interesting that that was a negative influence, a negative correlation in the data. The point on Intercom is really interesting. They're a customer of ours. We help with that pricing strategy. And what we're seeing there is a shift to perhaps some more interesting value metrics in pricing, moving away just from seat-based pricing to things where AI is actually driving value that people are willing to pay for as they receive more value. So in that instance, yes, every successful resolution, there's therefore an increased price. So super interesting. We totally see the same with AI natives in our base as well. And then on vertical SaaS, I find this really interesting because I do think, as you pointed out, it's partly about the market we're in, where predictability and efficiency is absolutely key. Because there are some fantastic horizontal SaaS players in the market at scale. But the cost it takes to enter a market with a horizontal play where you're serving lots of markets and use cases and personas is significant. And so we are seeing companies choose vertical focuses, which enables them to do a few things. Firstly, it enables them to understand a really tight ideal customer and go and reach that really tight ideal customer, number one. Number two, it enables people to build a multi-product strategy around a single end user. And we see add-ons and multiple products be a very strong correlation with growth in our data. So if you're able to then cross-sell and upsell multiple products into that same user, in which if you're in a vertical SaaS mode, you know everything about the end user, you know everything about their ecosystem, their problems, you can really get under the skin. And so now there's a real interesting opportunity, without having to go super broad and build lots of marketplace-type partnerships, of building a very compelling offering with build and buy. So I think there's a few things that are worth pulling out there. And yes, we are seeing a whole bunch of super interesting companies in extraordinarily small niches build big businesses. And then the application of AI to that is interesting too, because now you've got a bit more of a structured and understood data set to use AI to solve real-world problems within that very specific niche.
Yeah, and I mean, a theme in a lot of industries has been vendor consolidation, trying to right-size their SaaS spend, looking at the dozens or hundreds of SaaS tools they use and making sure that they're only paying for ones where they're seeing value. For many specific industries out there, especially Main Street businesses, there's no consolidating SaaS vendors because they don't have any SaaS vendors. Or maybe they have one, right? For many of these companies are newer in their digital transformation journeys, and they're looking for a vendor that understands the complexities of their business model and can build software that's really purpose-built for their workflows. And within our portfolio, just about every portfolio company that's growing north of 100% right now has some sort of vertical SaaS focus or vertical component. So a very big opportunity here. And I think that the trend with vertical AI also makes this super interesting, because then you can find really proprietary data sets relevant to an industry, and so combine software with data that makes AI really valuable, and find ways to get these customers to see value extremely quickly in a way that feels really purpose-built to what they're trying to do. Whether you see these AI applications in fields like legal or even fields like automotive repair, there's a ton of white space there. And for me, that's a super fascinating space. And one example that I could point to in our portfolio is we invested in a company called ChargeFlow, which works with small merchants who are navigating chargeback fraud. So if you buy something on your credit card and you go to dispute the transaction, now a merchant has to fill out a bunch of paperwork to prove that they actually delivered a service or a good to you. And newsflash, many don't know how to do it. It's time consuming, right? And so through a combination of AI and automation, ChargeFlow can do that on the merchant's behalf, and then they charge 25% of whatever revenue they get back for a merchant. And so it's extremely valuable to that customer. It drives real ROI, and it can scale really quickly. And so it's not one of the AI applications to summarize your notes, right, that we see all over the place. It has a real differentiated value.
Very cool. Well, we're going to go and move on now to an efficiency metric, which I love this one because even Andrew can calculate ARR by FTE. So Dave Kellogg will go up in a minute and talk more about metrics. Kyle can talk you till you're blue in the face about complicated metrics. Talk to us about ARR per FTE, why it's important and why it's rising in usage.
It's a metric you can't hide from. Everyone in the organization can calculate. And when we think about building an efficient business, one of the ways to see if you're on track is to see how much ARR you're able to generate for every employee on your team. And when you look at the benchmark data from 2022 versus 2023, there were significant improvements in ARR per FTE, really across all revenue bands. So you can see here, it's split by revenue band, and then good, which are the median companies in our data set, and great, which are the top quartile companies in the data set. So really increased. And I've even talked to companies. I did a PLG workshop with Esben from UserFlow, and he mentioned they're doing 4 million ARR with 3 employees. So the bounds of what's possible today in terms of ARR per FTE are extremely high. And I mean, for me, this is a metric that you should also take with a grain of salt. So this is a metric that I think of as an output metric. It's the result of being really purposeful and intentional in how you hire, how you manage your team, how you're growing. But it's not a metric to use to run your business in terms of day-to-day decision making, right? Otherwise, it will lead you to short-term optimization, but missing out on the bigger picture and the bigger opportunity. And so take it with a grain of salt. And the other thing is recognize that there's complexities around benchmarks here. So if your business is a low margin business, you might need a higher ARR per FTE, right, to be more margin adjusted. Or if you hire folks in lower cost geos, a lower ARR per FTE might be more reasonable because you have a lower cost base in terms of your employees. So don't plan your business around it, but track this as a North Star to see if you're on the right track.
Yeah. This is a classic case of the score will take care of itself. You've got to focus on building a great business, but it is one way of thinking about efficiency. So I love the way you frame that. All of the data here, and loads more, is coming out in the report that OpenView are publishing in partnership with Paddle. Please grab a snap of that QR code, and you'll get early access to that. Just as we finish, there are a couple of other kind of things and themes that we haven't had time to dig into, but are worth pulling out. And because we're in a European audience here, I think one of them that's really important is the strength of international. I've been in Bucharest, in Cluj, in Tel Aviv, in Paris over the last couple of months, and it's so gutting how many sessions are about this is how you break the US market. So present company accepted. We've got to have a better conversation here because what we see in our data is the strength of international markets. The US is growing this fast, but then all of these regional markets around the world are significantly stronger in their core growth rate, people buying software still. So one of the things that comes out in this is how important internationalization is, and that we shouldn't just look across the pond. Really, really key. There's a few more in there. Any other hot takes from you that you want to kind of tease people with before they download the report?
Yeah, totally. Well, and on the international side, if you're building a product-led or self-service business, you are by default international, right? You're always open for folks to buy, and even some smaller changes that you can make around localization, offering the right payment methods, right, for different countries, can make a huge difference in your international growth. The other thing is just it really pointed out to me that the data set here of the rise of the operator. So we're moving towards a model with leaner teams, right, less management layers, really focus on quality of the team, over quantity of team members. And the folks that are going to succeed in this environment are really able to take advantage of tools around automation and AI to instrument their go-to-market motions in a way that's super efficient. And those skills are really still being developed. You don't see a lot of companies really taking advantage of what's possible. But I've even talked to a unicorn that's doing all of their automated emails through one growth marketer where that's only part of their job, because they can leverage so many great off-the-shelf automation and AI tools for outbound prospecting. There's so much like that we'll discover over the next year. And so make sure that this is the year that, while even if you're not doubling the size of your team, the investments you're making are improving your operational performance to set you up for a really strong future.
Fantastic. Well, grab the QR code. Grab Kyle afterwards. I know he's happy. He's around for the next day or so to dig into any of this. Grab myself. I'll be at the booth. And on our LinkedIn, I know there's more report links and data being shared right now. And we really look forward to chatting this through in your situation in more depth. Because a lot of this is real summary level aggregate stuff. And the value of it is then applying it to every unique situation, use case, market. And we'd love to be part of that process. So thank you so much.
Thanks, everyone.